So obviously you can point them to the spot in the investment summary, as well as once they get to PPM, the spot in the PPM that goes over your strategy and the timeline. So this right here, they essentially want to know when's the close, and then when's the sale, and then in between there, what are some of the major milestones? Like when do you expect to have the renovations done? When do you expect to have your rental premiums? When do you expect to actually have your rental premiums in place? When do you expect to have the property stabilized from a vacancy perspective? When am I going to get my distributions? When am I getting my investor updates? Is there going to be a supplemental loan or refinance at some point? When's that going to come in? So this really depends on the business plan. So obviously you want to hit on when you plan on selling. So 5 years, 7 years, 10 years. Maybe explain why. Also, explain if you plan on refinancing or if you plan on obtaining a supplemental loan. And then also mention, and we've talked about this numerous times, mention that you're not including those in the return projections. So you're not going to see a 40% cash on cash return in year 3 because number one, it's technically not a return on investment, but a return of capital. So it's not really a cash on cash return. Plus, it'll throw off your annualized projections. If you've got 8%, then 9%, and then 40%, and then back down to 11%, then they ask why is the year 3 the best, and so why aren't you just selling at year 3? Thirdly, if you don't do the refinance, then your return projections are going to be thrown way off as well. You can also maybe explain to them how you're calculating your sales proceeds. So you plan on selling at this time. Maybe you'll do refinance at year 3, but you're not including that in the projections. Year 5, you plan on selling at, say, this cap rate. This is the cap rate you expect. It's higher than the cap rate we're buying it at, and here's how much money we expect to make at that point. Now, something else you can mention in this section is if you would consider selling the asset early. We'll learn this a little bit later on in syndication school when we talk about the kind of the asset manager's duties after you've acquired the property. But one thing that you want to do, kind of sneak peek, one thing you want to do is consistently evaluate the market. So not every day, not every week, but maybe every few months, and just take a look and see what similar properties are going for from a cap rate or a per unit perspective to see if it makes sense or if you hit your IRR goal sooner if you sell at year 3 or year 1.5 or year 4 or sometime earlier, because remember IRR is tied to time. So if I give you $1,000 tomorrow, it's not worth as much as me giving you, or it's worth more than me giving you $1,000 2 years from now. So if you can sell for the same price a year early, then technically that getting that money now is worth more than getting that money in the future.